All right, what's up, traders? What's up, tycoons? We're gonna go over the smart money versus dumb money chart in today's video. Now, investors use the comparison between high yield corporate bonds and the S&P 500 to gauge the sentiment and risk appetite of different market participants. High yield bonds are often referred to as smart money because they're usually traded by more sophisticated investors who are sensitive to credit risk. The S&P 500, often considered dumb money, represents the broader market and retail investor sentiment. Now, you can use this chart to spot divergences as well, right? And when there's a divergence between HYG and SPX, it can signal potential market turning points. When HYG stalls or shows weakness while the SPX continues to rise, it may indicate underlying risks not yet priced into equities. Now, that's just a broad view, broad way to look at it. That's one way to look at it. Another thing is, in the current market environment, we're seeing valuations rise in the stock market. We're seeing new all-time high being made, but we're not seeing new highs being made in the bond market. And a big reason of that is because the Fed funds rate is still very elevated, right? The Fed has not started cutting rates yet. And so there's going to be always ever-changing dynamics and constants, in the markets. That's one reason why we really haven't seen bonds break out is simply because yields and the Fed funds rates, rates in general are still remaining higher for longer. We have not really started to see that decline in rates. Now, you can also use this chart for confluence. When both the HYG and the SPX move in tandem, it really suggests a strong market sentiment and a risk-on environment if they're both moving on in the upwards direction. If they're both moving in the downwards direction, all right, it really suggests, strong confluence that, hey, we're in a very risk-off environment, right? And we're seeing investors, in a very risk-off environment, right? Now, the red dashed line is showing resistance in the HYG, and this is basically just suggesting that bond investors are still cautious, even as equity investors via the SPX remain bullish. This caution can be a precursor to potential corrections in the equity market, and this layout helps investors understand the risk sentiment among different market participants by comparing the performance of high-yield bonds and the broader equity market, providing insights into potential market risks and turning points. So, that wraps up our summary of the smart money versus dumb money chart layout that we've got here. All right, we've got smart money, HYG on top, and we've got dumb money, SPX on the bottom. I didn't come up with these names of smart money and dumb money, but I do pay attention to yields, and I do use the bond market oftentimes as a leading indicator for the stock market. And it's something that really can be useful once you start to understand how to use it and you start to understand some of these intermarket relationships.